When the Federal Reserve decided to take drastic measures to support the economy last year, they implemented a variety of policies to keep money moving in the markets. Part of this flurry of policies was dropping interest rates to near 0%. Money became cheap to borrow, and more lending meant more opportunities to keep money circulating, including in the equities markets. Stocks rebounded after their drastic fall in March of 2020, and now we're seeing the stock market hit all-time highs at a time when recovery is just really starting and pandemic worries are on the uptick. So stocks have become very expensive, and not for the same reasons as AMC and GameStop. Let's talk about some of the sickness in the market. Let's talk about why AMC and GameStop are a symptom, and let's get to it. What's up YouTube, James from Thursday Media here, and in this video we're digging into some real problems to be aware of before deciding to invest in the coming months. The Federal Reserve adopted several easy money measures over the past year that have helped fuel stocks to new highs. It seems like every week now we set a new record, but that seems oxymoronic as going out into communities provides a very different story. There are still closed doors, limited hours, and never-ending now hiring signs that are just some of the scars left by lockdowns and mandates imposed during 2020. While some businesses did survive, many did not, and there are some that are still not operational due to restrictions from governing bodies. But one thing that lockdowns have not stopped is your ability to hit the like button so that YouTube knows that we're still in the game. What's crazy is the stock market should act as a barometer for the health of the economy. The higher the index numbers go, the better the economy is doing. But this is obviously not the case, as the Federal Reserve's intervention into the market's activities has allowed this barometer to break. And we are seeing this impact sectors in different ways. The housing market is booming as home prices are reaching new highs and prospective home buyers are bidding on houses without even looking at them. Tech companies have soared in value, SPACs have exploded, and IPOs are more and more common as companies scramble to enter the stock market during some incredibly unique times. ROBINHOOD, as a prime example, took advantage of the abnormal amount of new customers and unique market situations, which has fed its revenue year over year, to launch their IPO this week, despite the negative press. That is very telling about how hot the market currently is and how important companies find it to go public before the Fed changes course. So why do AMC and GameStop matter as it relates to the Fed's monetary policy? Well, every time that the Fed meets and decides to keep interest rates low, it continues to fuel this expensive market. With nearly $8 trillion of borrowed money fueling the market, we can assume that a lot of this money is pushing the large tech company moves to the upside, but also the shorting used to push many companies to the downside. And the obvious targets of massive amounts of shorting were companies directly crippled by government lockdowns. Cruise lines, airlines, places of large assembly such as AMC theaters, and small retailers such as GameStop. At a time when the policy was supposed to be helping businesses, hedge funds and investment firms went on the attack to drive these already crippled companies to bankruptcy. And yes, we can make the argument that these companies were already weak before the government imposed restrictions. But the reality is government policy and easy borrowing encouraged these businesses to be attacked. And it's a real shame because in the case of some companies like airlines, for instance, they didn't do anything wrong, yet their shareholders had to deal with declining P&L, restrictions on stock buybacks for price support, and the elimination of company dividends. Yet airline companies were provided no protection from institutional shorting and stock price manipulation during a time that they were prevented from freely operating their businesses. So as retailers continue to pile into heavily shorted stocks, the Federal Reserve's policies are one of the few saving graces for hedge funds. The day the Fed decides to begin increasing interest rates is the day we see those expensive stocks tumble back to fairer prices, and with increasing pressure, we will see them exit their leveraged short positions as well. And we see the DTCC preparing for such a scenario as they continue introducing new policies. And these policies are for preventing even blue chip stocks from collapsing due to fire sales from poor collateral management and over-leveraging in the market. The fact is, there's way too much borrowed money fueling the stock market. Stocks in general are very expensive based on their historical PE ratios, and it's likely to last a bit longer now that Jerome Powell has signaled that the Federal Reserve has no intention of changing course in the near future. This sounds like a bullish move for the market, but the fuel runs out the moment that the Fed begins tightening. And the worst part about this, banks and other institutions will likely be in the know well before it happens and begin selling their overpriced holdings slowly to individuals like you and me. At the same time, they'll be releasing research explaining why this company or that might be worth buying. Who picks up these shares that they're selling? That'd be retail investors, and they become the bag holders. I'm bringing this up now because I believe that we're about to start entering the stages where certain sectors of the market are going to cool off for a while. And if you're invested in individual stocks, you need to make sure that you either have a high conviction in that stock, have a great entry point, or be prepared to move that money elsewhere. I know many of you are heavily invested in GameStop and AMC, and any market tumble may have an initial negative impact on their stock prices because they're connected to ETFs, which would fall with the indices. But when the money lent to create many of the short positions needs to be returned, we could finally see some of those positions begin to be covered. This could take a while. So while this waiting game continues, make sure to consider your other investments and their potential exposure to being heavily impacted during a stock market correction. That being said, with some analysts looking at the coming downtrend as the mother of all crashes, there will probably be a correction across all sectors. It will be during this time, when lending becomes much harder and major stocks are correcting, that I'll be interested in seeing what retail trading does with stocks like AMC and GME. Fidelity provides a great chart that shows which sectors fare better in each cycle. I'll leave a link so you can check it out. This isn't to say you need to sell all your stocks, especially if you have good entry positions, but be careful of what you're buying right now because just about everything is expensive. Instead, look ahead and think about investing your money in preparation for the next cycle, finding those solid companies that are fair or maybe even undervalued. You can also consider saving and waiting for that correction to find deals. Of course, if your high conviction play is AMC or GameStop, then make sure you are good to hold through those ups and downs as we continue to buy, hold, and wait, as I'm sure they deserve a category of their own on the sector chart. Maybe they could call them consumer apish. But as always, I am not a financial advisor. I'm just a regular guy with a regular job, just looking to get ahead of an impending market correction. So always make sure that you do your own research before making any financial decision and that you make financial decisions that you're comfortable with. If you want to dip your toe into investing, I'll leave you some links down in the description below that'll help get you started. One of these is even offering free trades without payment for order flow. If you like this video and you want more like it, make sure that you subscribe to the channel. I post twice a week unless I throw in a bonus. Make sure to do some serious due diligence on what you buy right now, be prepared for a correction, and thanks so much for being here, and I'll see you in the next one.
Player one, it's up to you. What are we doing? Alright, let's see what we're doing here. A good year to land on the moon. And it looks like you can win 1,000 greenbacks for this one.